Thank you very much for joining us here on ET Now. You're watching Business at 9. I'm Nivedna Prabhu. Let's put the spotlight on how Swiggy, India's food delivery titan, is set to launch Toing, a standalone app targeting budget-conscious diners with a debut in Pune's student hubs. Now, aimed at Gen Z and young professionals, Toing offers meals under 250 rupees, mostly 100 to 150, catering to frequent cost-savvy orderers. Now, building on Swiggy's value-driven experiments like the 99 store and the Pocket Hero, Toing is designed to drive high-volume, low-cost orders in a but obvious competitive market. Now, as rivals like Zomato hike platform fees, Swiggy is betting on affordability to lock in loyalty and data. Will Toing redefine budget dining or intensify the price wars? In India's cutthroat food tech arena, Swiggy is trying to give the impression that it is playing to win. But to decode that, before we get into a conversation with my special guest, my colleague Anjali is here to explain that into detail. Let's take a look.
Right, so Swiggy has launched a brand new app called Toing, which is going to specifically focus on the affordability factor with meals largely in the 49 rupee to 250 rupee range. Now, this has been launched as a pilot in select areas in Pune, about 4 or 5 of them. And according to a source at the company, this has been done to target the student population as well as the early career professionals in these cities. And this is largely an affordability push coming in from Swiggy. Now, why a separate app? So what's really going to be different from the main Swiggy food delivery app? Well, we've noticed quite a few differences. One is that there is no search fee that this new app Toing promises during peak hours, and in addition with that, they also promise parity with offline prices, meaning the prices that you see on menu cards in restaurants, that is the price you will see online as well. Now, this has been a point of contention that many users have been pointing out, and there will also be a difference in the platform fee. So while Swiggy charges a platform fee of 15 rupees, on Toing, the platform fee is currently at rupees 12. So these are a few items, these are a few things that will lead to Toing being more affordable, but exactly how much? We compared the order for the same item on Swiggy and Toing and found a whopping 80% difference in the pricing. So to begin with, the listing pricing on Swiggy for this item was 225 versus 200 on Toing, and a further discount on it put the price at 149 rupees. The delivery fee, any order above 99 rupees on Toing has no delivery fee, whereas a 41 rupee delivery charge was added on Swiggy without the Swiggy One membership. There were no packaging charges on Toing, whereas 10 rupees were charged on Swiggy, and the restaurant GST also differed due to the difference in the item cost. And lastly, the platform fee, which was higher on Swiggy, was 3 rupees lower on Toing. That led to a cumulative difference of 80% coming in on the price of the same item on Swiggy versus Toing. So as you can see, there is a big difference. This is a push for affordability that Swiggy is doing with the launch of this specific app. But why really is Swiggy looking at this particular cohort? If we refer back to a shareholders letter that Swiggy had issued, in which they said that they will ensure that peers don't get a clear opening, and this is what all of their new offerings will focus on. We also saw the launch of the 99 store within the Swiggy app, as well as Snack, which was another app that was launched, both focusing on the affordability factor. And at the same time, we saw a rival, Rapido, entering into the food delivery space, and they also promise lower prices in the form of lower commissions also being charged to restaurants, and lower prices for the customers as well. So we are seeing that Swiggy wants to make sure that the competitors don't get ahead of them. In fact, Swiggy is also looking to sell off their 12% stake in Rapido at the moment. So this is another push that is coming in from Swiggy for affordability with the launch of Toing.
All right, Anjali put that into context, but to decode that further, my special guest joins me this evening, Karan Taurani, EVP Elara Capital. Karan, thank you very much for taking the time out and joining me here this evening. Let's begin on a lighter note. Swiggy's new move, do you think it'll deliver with the right taste?
Hi, good evening. I think this is a good move by Swiggy. If you look at the food business, the growth rates in the food tech segment have converged more from a 25-30% growth GOV number more towards 18-20% in the near term. And that's how the numbers will look like. So I think a lot of innovation is happening in this business. One we saw on the quicker delivery business, wherein you saw Swiggy getting into Bolt. We have also seen the proposition of snack, wherein there is Zepto Cafe, there is Bistro by Blinkit, Zomato Food rather, wherein you're going to get different kinds of food being delivered as well. So I think there is ample appetite here in the food tech market. The market size is about $12 to $13 billion. The growth is not very high in terms of the number of growth rates or the number of users from here on, because this segment is reasonably penetrated as we see. But these kind of propositions will only attract more users. It will try and test new models in the business, more use cases, and also drive more frequency. I think, if you look at the AOV, typically if the AOV is smaller, what happens is the consumer can actually order more frequently, and it's appealing to the Gen Z consumers who actually want that kind of food. And they may actually get lost in Zomato or Swiggy in terms of the app, because the kind of number of restaurants that they have, the kind of variety that they have is actually very huge. So this is actually kind of going deeper in terms of micro markets, or going in deeper in terms of customer segmentation and trying to have a formidable proposition there. Now, whether or not these things scale up is a question mark, whether or not in terms of how these things will actually have an impact in terms of overall profitability metrics and the dynamics of the existing business. That is a monitorable from here on. But I think it's a good thing to try and experiment with these kind of new things, which could lead to mild acceleration in the frequency and also drive growth rates in the food tech segment.
In fact, as you point that out, what has been, of course, the peg here is also the affordability aspect, right? And that's essentially what we've been talking about, and also showing those numbers as well. And it's perhaps become the core consumer hook as well for this. But does it reduce differentiation across platforms and perhaps shifts the battlegrounds to, let's say, adjacencies such as quick commerce, dining out, or just looking at this entire services sector? Do you think in the longer term this is going to pan out really well?
As I said, these are try and test propositions. We don't have any idea in terms of how things will pan out. So let's look at the case in terms of the quicker delivery. Something like a Bolt contributes anyway about 10 to 12% of GOV for Swiggy. Unit economics, may not be as favorable as a normal delivery proposition does. But, Swiggy does have that as a feature, as a proposition. In the case of Zomato, now they have shut the quick delivery format and they only operate in the bistro format. So I think each one to its own in terms of where they operate, what is the kind of focus they have in terms of whether their focus is growth or profitability, or to make sure that no new entrant comes in this segment and they won't have personal advantage over there. Like in the case of Rapido, they might cater to this segment. That's one thing in terms of how each of the companies will operate, because there is no proper data here which is backed whether or not these businesses or these segments rather can be successful within food tech. Second thing you have to watch is that there's ample opportunity for food tech to penetrate further in the smaller markets. Obviously, this service is now being launched in Pune, which is a metro market. But if you look at the non-metro markets, if you look at the number of cities in terms of penetration, which is possible for food tech as a business model, there is still ample opportunity here. If you look at the largest QSR chain in the country, which is Domino's Pizza, obviously they operate, on a brick and mortar model. They are in close to about 400 plus cities odd. If you look at Zomato, Swiggy, the large food tech incumbents, they are in about 800,000 cities odd. But in India, we've got close to 3,000 to 4,000 cities. So there's ample opportunity for these business models to actually penetrate further. So as I said, these things will eventually be tried out in the metro markets first. You can test the economics, you can test the consumer acceptance, you can test the consumer behavior. And if at all these models take off, they can become a very big success in the non-metro markets or in the markets where Swiggy and Zomato have made an exit in the past. In terms of better unit economics, if at all. And that in turn can accelerate the growth in the food tech segment, which has seen a convergence towards 18-20%.
Karan, as you pointed out, and looking at what could the rationale be behind this, because when you look at how with rivals like Zomato adjusting platform fees, now we have Toing representing a defensive strategy to lock in that price sensitive segment, or do you think it's a proactive attempt to reshape the market perhaps?
I think it's a proactive attempt to reshape the market. Again, the same point here. So they are trying various ways to make sure that the consumer experience becomes better.
Yeah.
So in the case of Bolt, the lead times actually became lower to 10 minutes, 15 minutes. I think this is more of a consumer experience effort than the product. So if you look at Bolt as a proposition, what is actually being delivered in 10 minutes are the ready-made foods like cake, pastries, bakery items which are there, which were earlier also delivered within 10 minutes. But just like a value add in the mindset of a consumer that you get the food within 10 minutes. It is not the regular food, the biryanis or the Indian food which is being delivered within 10 minutes, right? It's just the ready-made food which is there. Then they moved on to this entire, Zepto Cafe, Bistro kind of offering wherein they had backward integration. Most of the food is basically on-the-go food, cafe, sandwiches kind of food, which is made in-house, maybe through cloud operators or through their own restaurants at the back end. And they are trying to enhance user experience on that front as well in terms of increasing the variety or the assortment of food that they have on their platform. And now it comes down, to actually have an app which is actually appealing to the lower end of the audience in terms of pricing and affordability. And as I said, many consumers actually get lost because Zomato and Swiggy rather have got more than 3 lakh restaurants listed on the platform today. So when you search for a product, you are actually lost in terms of a wide range of variety of products in the range of 50 rupees to even 1,000 rupees. So this actually, does well for, the consumer audience in the Gen Z or the college-going students who would actually want to order these kind of products on a regular basis. And it drives frequency. So for them, life becomes easier. They don't need to scroll and, spend too much of time in terms of, getting the right product. They can just go on this app and call the product based on their budget and the amount of money they want to spend. And last but not the least, I think this has to pick up in the non-metro markets also in a very big manner, especially in the tier 3 and tier 4 markets, which is a huge untapped opportunity for the food segment.
Karan, do you also expect, while you of course point that out, and it's a very valid point that you make, do you expect Zomato or other rivals to respond with similar affordability offerings, or might they leverage their scale differently to avoid diluting margins?
So actually they can. If you look at the likes of Swiggy, they've actually been very innovative in launching multiple things, and Zomato, piggybacks on whatever Swiggy does and eventually does a better job in terms of execution. We have seen that on the quick commerce side as well. We have seen that on the food side as well. Zomato was a restaurant discovery platform. If you remember, they came into food delivery. Now they're market leaders and they've got a higher market share versus Swiggy. So on execution, historically, on a track record basis, Zomato has been better versus Swiggy. But on innovation side, in terms of trying out new things, Swiggy obviously has an edge. So definitely Zomato could potentially try to do this. But if you look at Zomato, their profitability margins are at a wide gap versus Swiggy. There is a 250 bips gap in terms of EBITDA as a percentage of GOV for Zomato, which is higher in terms of margin as compared to Swiggy. So if their focus is profitability, if their focus is to drive growth through frequency, through increased number of customers, I don't think that they will launch anything of this sort at a large scale if it leads to higher cash burn or losses for them. But if at all the growth rates converge further, for example, if you say the growth rates in the food tech business do come down eventually in the range of 14-15% from 18-20% right now, then there is a possibility that Zomato also may do these kind of things to actually chase growth. But as of now, given Zomato's focus on profitability on food part and given the gap that they have versus Swiggy, it seems unlikely that they will do this kind of proposition for now, because they want to appeal to the entire end of the audience and not the lower end of the audience, which is margin dilutive in nature for them.
Right, Karan. In fact, I want to thank you on that note for taking the time out and drawing perspective as to how you're essentially looking at it. Only time is going to tell if this is actually going to be a hit or not. But with that, we leave the conversation over there, because we're also slipping into a quick break here on Business at 9. But lots more to continue on the other side. Don't go anywhere. We'll be right back. Welcome back. You're watching Business at 9. Now, ending months of standoff, U.S. President Donald Trump announced that the U.S. and China have reached a deal allowing TikTok to continue operating. Now, announcement on new buyer for TikTok is expected soon, but listen into what he said.
Well, we have a deal on TikTok. I've reached a deal with China. I'm going to speak to President Xi on Friday to confirm everything up. We made a very good trade deal, and I hope good for both countries, but a very different deal than they've made in the past.
All right, let's shift our focus. The one-day meeting held today brought together India's chief negotiator, Rajesh Agarwal, and his U.S. counterpart, Assistant U.S. Trade Representative, Brendan Lynch. Now, the discussions focused on resolving long-standing issues, including market access for goods, services, and investments. It was decided to intensify efforts to achieve an early conclusion of a mutually beneficial trade agreement. Read the statement that was released. Listen in to Sumita, my colleague.
That's right. A trade team from the United States led by Chief Negotiator Brendan Lynch arrived in India, and he arrived in India last night, and today discussions went on for the entire day. He held those discussions with India's trade team led by India's Chief Negotiator and Special Secretary Rajesh Agarwal. Remember, these discussions were essentially revolving and centered around India-US trade ties, along with discussions on India-US bilateral trade agreement. These were not the sixth round of negotiations. These were essentially a precursor to the sixth round of negotiations, which were essentially and initially slated for August 25th. However, they had to be pushed due to a discord between India and the United States on account of India's energy trade with Russia. Remember, that's a charge that India has dismissed, and India has stated that it's really perplexed by that charge that's been made by the United States. Now, coming back to these discussions that happened today, we're given to understand from a Commerce Ministry statement that discussions were positive and forward-looking. That's essentially also the stance of the U.S. Embassy as well, which in a statement has called these talks positive. The Commerce Ministry also states that these discussions covered various aspects of the trade deal, and it was decided to intensify efforts to achieve an early conclusion of a mutually beneficial trade agreement. Now, this line is particularly important given the fact that Commerce Minister Piyush Goyal in just the past few days has stated that India is hoping to reach the first tranche of the bilateral trade agreement by November or so. And there's been an eagerness from both the sides to wrap up the early tranche, to wrap up the first tranche of the BTA by fall, as both the leaders, President Trump and Prime Minister Modi, decided upon earlier this year when they met in the White House. Now, remember, while these details are important, it's also important to point out what industry body GTRI has essentially stated. It states in a note that negotiations will remain slow until Washington signals genuine flexibility. It's also stated that without the rollback of oil-linked duty, no breakthrough is politically or economically viable. It also states that there are mixed signals that's been given by the United States side, but essentially everything hinges on whether concessions will be made by the United States as far as its access to the Indian agri-market is concerned.
All right, Sumita, thank you for joining us with the latest. But let's also tell you, given what we need to know, at least what's happening tomorrow, Snehi, my colleague, is here with the cues to watch out for. Let's listen in.
Well, yes, lots of cues to watch out for, and while not much is happening back home from the US, all eyes are going to be on that FOMC Fed meeting outcome. Remember, this continued pressure coming in from US President Donald Trump on Chair Jerome Powell to reduce rates. The street is largely penciling in for this to happen. A 25 bips cut is the expectation, so let's see what the outcome is. But other than that, from the UK, CPI and retail price index numbers are expected. From Eurozone, CPI and the ECB wage tracker data will be out, and from China, their trade data will also be out, so watch out for that. In terms of global earnings, all eyes are going to be on General Mills, all set to report its earnings. But shifting focus back home, once again, let's talk about some corporate action and board meetings and some stocks to watch out for. On the back of all of these actions, Garware High-Tech Films, KRBL, Rice and Shilpa Medicare will be trading ex-dividend. It's going to be the last day to buy the shares of Zydus Wellness to be eligible for their 1:5 stock split record date if you wish to do so. And it's also going to be the last day to buy shares of GMDC, Hindustan Copper, Jamna Auto, Shakti Pumps, Venus Pipes and many more stocks if you wish to be eligible for their dividend record date. In terms of AGMs, their annual general meetings, watch out for PNB Guild, Subro, Sadur Manganese, Astra Microwave as well as Aether Energy. By shifting focus from the secondary to the primary markets, lots of action expected on the IPO front, because you'll have the VMS TMT IPO that will be opening for subscription, and 3 IPOs will be making their D-Street debut: Shringar House of Mangal Sutra, Urban Company as well as Wave Accelerators. Lastly, in terms of some other events, Donald Trump will be continuing his visit to the UK, so watch out for announcements on that front. You'll have ECB President Christine Lagarde also all set to speak in Frankfurt, so any commentary from there is also important to track. But well, yes, watch out for all of these cues very closely.
All right, Snehi, thank you for joining us. But let's move on to a big development because Groww has filed an updated DRHP with SEBI for an IPO of about 7,000 crores. The planned IPO size, 1,050 crore fresh capital raise, plus the 5,000 to 6,000 crore offer for sale by existing investors. Remember, the founders hold 27.96% with a 20% lock-in for a 1.5 year period that's post-listing. They're offering to sell only 0.07% of shares in the IPO. The funds raised will be used to expand margin trading, unsecured lending, wealth management, and possibly inorganic growth as well. Now, the financial year 25 profit surged over threefold to 1,819 crore. Revenue increased 31% to 4,056 crore versus the financial year 24. Let's also tell you the IPO banks include JP Morgan Chase and Company and Kotak Mahindra Bank Limited. But with that, at least we leave it at that as far as Groww is concerned. Let's move on to more significant developments we are tracking as far as global news is concerned, because at least 78 Palestinians have been killed so far in Gaza as the Israeli military began the ground invasion of Gaza City. Palestinians were forced to flee with just minutes to spare before intensified Israeli attacks as the army pushed deep into the densely populated region. The operation marks yet another escalation in a conflict that has roiled the Middle East for nearly 2 years and likely pushes any ceasefire farther out of reach. Now, the military wouldn't offer a timeline for the offensive, which it says aims to destroy Hamas military infrastructure, but Israeli media suggested it could take months. We'll keep a close eye on that and a lot more. But for the moment, that's all that I have for you in this edition of Business at 9. Thank you very much for joining my team and I this evening. With that, it's a wrap. Good night.
Financial services as a market will never be a true winner take all. It's always going to be many players doing many things. You've seen that in banks, you will see that in insurance companies, you'll see that in almost every category. When we think about every step that any regulator takes is always to protect the end consumer. Like I said, all our rounds were anticipated and done internally. We kind of remain focused on the business and not think about raising money, IP or valuation at this point. Right.